if you're an income investor, well, you've probably felt it right. That frustration. You're hunting for decent yields, but the market often feels like it's serving up pretty slim pickings from the big names or maybe just pure speculation with zero income. It can feel like those really high yield plays are, well, almost mythical these days. But today, we're going to dive deep into something a bit different. Something that honestly boasts an almost unbelievable 20% plus annual yield. Okay, now, before you think this sounds way too good to be true, let's be crystal clear. The income potential here, it's genuinely off the charts. But, and this is a big but, the risks are just as significant. We're not talking about some shady fly-by-night operation. Our focus today is on a publicly traded fund called Oxford Lane Capital Corp. The ticker is OXLC. And its whole strategy revolves around investing in something called collateralized loan obligations, or CLOs, specifically kind of the deeper, riskier parts of them. It's definitely niche, maybe even a bit nerdy, you could say. But for the right kind of investor, maybe, just maybe, it's a rare opportunity right now.
That's exactly right. What we want to do in this deep dive is really unpack what OXLC actually is, why the current environment might be making it look like, well, a unique opportunity. And crucially, we need to shine a very bright light on the substantial risks that come along with it. The goal here is for you to walk away really understanding all the moving parts so you can figure out if it even remotely fits with how you invest.
Okay, let's start unpacking then. What exactly is OXLC? Lay it out for us.
Sure. So Oxford Lane Capital Corp, it's a publicly traded company, specifically a closed-end management investment company. You can find it on the NASDAQ, ticker OXLC, like you said. Its main business, its core strategy, is investing in these things called CLOs, collateralized loan obligations. And even more specifically, they tend to focus on the equity and the junior debt tranches of these CLOs. Right. So what are CLOs? For anyone not steeped in structured finance, you think of them as basically baskets or portfolios of loans. These are loans made to companies that, frankly, have less than stellar credit ratings, non-investment grade, sometimes called leveraged loans. It's a way to bundle up this higher yield corporate debt. Maybe think of it like a junk bond fund, but on steroids, potentially higher risk, higher reward, and definitely a lot more complicated in structure. And CLOs themselves, they aren't brand new. They've been around since the 1990s, actually. Big institutional players like insurance companies and pension funds, they often like them because the yields can be high and, importantly, often floating rate.
Okay, so CLOs are pools of risky loans. But what makes OXLC's approach different? You mentioned the equity and junior tranches.
Exactly. That's the key distinction.
Okay.
OXLC tends to load up on the very riskiest slices of these CLO structures, primarily the equity tranche. Now, the equity tranche is the last in line to get paid the cash flows coming from the underlying loans. But, and this is critical, it's also the very first piece to absorb losses if those loans start to go bad, if companies start defaulting.
The first to absorb losses. Okay, so they're intentionally buying the part that gets hit first if things go wrong. That sounds, well, inherently volatile for someone just looking for income. How does that possibly translate into anything positive?
It's a fair question, a really important one. The payoff from OXLC's perspective is simple. Income. Potentially massive, market-beating, sometimes palm-sweating income. By taking on that concentrated risk, that first loss position in the equity piece, they position themselves to capture really outsized returns, outsized income streams, if the underlying loan pools perform well enough. It's definitely a high-stakes bet on yield.
And that income number, it really does jump off the page. As we're talking right now, OXLC is sporting a dividend yield somewhere around 24%. That is not a typo, 24%.
Okay, hold on. Before anyone listening gets too excited and thinks about dumping their life savings into this, you absolutely must understand this fundamental truth. That kind of sky-high yield always comes with equally high risk. This is not, and I repeat not, like buying shares of Procter & Gamble or Coca-Cola and just, tucking them away for 10 years. This isn't a sleep well at night holding in the traditional sense. What we're talking about here is really active income investing, that huge yield. That's basically your compensation, your reward for being willing to stomach some potentially pretty gnarly risks and volatility.
Right, understood. High yield, high risk. But beyond just that headline number, what makes this potentially interesting right now? Like you said, the market doesn't usually hand out 24% yields unless something is seriously wrong, or maybe if it's just completely misjudging the actual risk level. With OXLC, it seems like there might be a few sort of specific factors working in its favor at the moment.
Yes, exactly. And this is where it gets, well, really interesting for potential investors. First off, OXLC shares, like many closed-end funds, often trade at a discount to their net asset value, or NAV. Basically, that means the market price for a share is less than the calculated value of all the underlying assets the fund holds, divided by the number of shares. So it's like buying $1 worth of assets for, say, 80 or 90 cents.
Like getting a discount on the underlying CLO pieces.
Precisely. Now, discounts aren't guaranteed profits. They can persist or even widen, but it does offer a potential buffer, a sort of margin of safety. And if that discount narrows or if the underlying NAV itself goes up, well, that offers potential for the share price to appreciate too, on top of the income.
Okay, discount to NAV, that's one point. What else?
Second, and this is pretty significant, I think, OXLC recently announced a really substantial stock repurchase program. They've authorized buying back up to $150 million worth of their own stock running through 2026. Now, that's what you might call a rare double win for shareholders. Why? Because when a company buys back its own shares, it reduces the total number of shares outstanding. That can help support the stock price. And especially if they buy back shares when the stock is trading at a discount to NAV, it can actually increase the NAV per remaining share. In a world where lots of companies issue new shares and dilute existing holders, seeing a big buyback like this is frankly a breath of fresh air. It signals management confidence. It's bullish.
$150 million buyback, that's quite something. Okay, so discount buyback, what's the third factor?
The third one relates to interest rates. Most of the underlying loans within these CLOs are floating rate loans. This is really key. It means that when broader interest rates go up, the interest payments generated by those loans generally go up too. The yield on the assets rises with rates.
Ah, so it's kind of an inflation hedge.
Exactly.
Yeah.
That's potentially a beautiful thing, especially in an environment where inflation has been a concern or where rates might stay higher for longer. Think about it. Many traditional income investments, like maybe some REITs, utilities, or long-duration bond funds, they tend to get pressured, sometimes even crushed, when interest rates rise sharply. OXLC, because of those floating rate assets, is positioned quite differently. It can actually benefit from rising rates, at least on the income side.
Okay, those are some compelling points. The discount, the buyback, the floating rates. But as we said, a 24% yield doesn't come free. We absolutely have to talk about the risks. What are the big ones people must understand?
Absolutely critical. Let's not sugarcoat this. The number one risk comes right back to what OXLC invests in. That's CLO equity tranche. We keep saying it, but it bears repeating. They deliberately buy the riskiest, most subordinated piece. Last to get paid, first to take losses if the underlying companies struggle and loan defaults tick up. What does that mean practically? It means distributions, those hefty dividend payments could potentially be cut, and maybe cut severely if conditions worsen. It also means the NAV, the fund's underlying value, could get hammered.
Hammered is a strong word. Can you give us an example?
Yeah, look back at the COVID crash in early 2020. That sudden economic shock sent tremors through the credit markets. OXLC's share price, it absolutely plummeted. Went from over $9 a share down to below $3 in a very short space of time.
Wow, that's more than a 60% drop.
It was brutal. And it took well over a year for the share price just to claw back some of those losses. That is the kind of gut-wrenching volatility you absolutely need to be prepared to stomach if you're investing here. That's not a minor dip. That's a potential capital destroyer if you panic sell.
Okay, extreme volatility risk. Check. What else?
Second major risk area is distribution coverage. We see that huge 24% yield, but where does the money actually come from? Ideally, a fund's distributions should be covered by its net investment income, or NII basically, the income earned from its investments minus expenses. With OXLC, the distributions are so high that they are not always fully covered by NII. Sometimes a portion of that payout might actually be classified as a return of capital, or ROC.
Return of capital? Sounds like they're just giving you your own money back.
In a way, yes. It means part of the distribution isn't earnings, it's dipping into the fund's asset base. Think of it like taking money out of your savings account to pay your bills instead of using just your paycheck interest. Now, some ROC isn't necessarily catastrophic, especially for closed-end funds, but you absolutely need to track this. Is the fund consistently earning enough to sustain that payout, or is it slowly eroding its own capital base to maintain the high yield? That's a crucial thing to watch.
Makes sense. Monitor the NII coverage. What's the third big risk?
Leverage, debt. Like many closed-end funds aiming for high returns, OXLC uses borrowed money leverage to essentially juice its returns on its investments. When things are going well, leverage can magnify gains. That's the upside. But, and it's a huge but, it also magnifies losses when things go wrong. It adds another significant layer of risk. If OXLC's borrowing costs go up substantially, or if the credit market sees up and make it harder or more expensive to borrow, that leverage can quickly turn from a helpful tool into a major liability. It amplifies the volatility we already talked about.
Okay, so we have CLO, equity risk, potential distribution cuts, NAV volatility exemplified by that 2020 crash, questions around distribution coverage and NII, and the added risk from leverage. That's quite a list.
It is. And anyone considering this needs to go in with their eyes wide open to all of them.
So putting it all together, who is this fund actually for, and why might now be a particularly interesting, if risky, moment to look at it?
Right, let's be really clear about the target audience. This is absolutely not a fund for, say, conservative retirees who need stable, predictable income to cover their monthly grocery bills. It's just not. It's not a sleep well at night bond fund replacement. It's not a dividend aristocrat you buy and hold forever without checking on it. OXLC is more like a tactical income weapon. It's potentially suitable for more experienced investors, people who really understand credit risk, who understand structured products, who are willing to learn. It's for investors who are genuinely comfortable with and can tolerate significant price volatility. People who might be prioritizing capturing that very high yield right now, maybe more than focusing solely on total return, and folks looking for tactical opportunities rather than long-term set-and-forget holdings.
So it requires active involvement then.
Absolutely. You can't just buy this and ignore it. You need to treat it almost like a high-maintenance house guest. You need to keep tabs on it. That means regularly monitoring the NAV, watching the distribution coverage reports, paying attention to the overall interest rate environment, and, really importantly, keeping an eye on default trends in the underlying leveraged loan market. This is definitely a hands-on investment.
Okay, and the why now part. What makes the current moment potentially unique?
Well, the why now thesis, for those who find it compelling, is largely about market perception versus reality. Right now, you could argue the market is pricing OXLC and perhaps CLO equity more broadly as if we're plunging headfirst into a severe recession tomorrow. The pricing seems to imply that CLOs will be among the first assets to get completely torched in that scenario.
Which might be overly pessimistic.
It might be. While a deep recession would certainly hurt CLO performance, the argument is that the market might be overstating the imminent danger or underestimating the resilience built into CLOs, especially since the reforms after the 2008 crisis. CLO structures are generally more robust now. There's better transparency than there used to be. And if you look at the actual credit environment recently, while risks remain, default rates in the leveraged loan market have been relatively manageable so far. Plus, you have inflation potentially coming under control, the Fed hitting pause on rate hikes for now. The backdrop isn't necessarily screaming imminent doom the way the fund's yield and discount might suggest. So the opportunity, if you believe this view, is that disconnect. While maybe the broader market is chasing, the same 10 big tech stocks, funds like OXLC are sitting over here potentially undervalued, quietly churning out massive income. That contrast creates the rare opportunity feel for some.
Interesting. So if someone is intrigued, if they fit that experienced, risk-tolerant profile, what are the key numbers, the specific metrics they absolutely need to watch like a hawk?
Okay, key metrics rundown. Number one, net investment income, NII per share. You want to see this number ideally covering or even exceeding the per share dividend amount each quarter. That tells you the distribution is likely sustainable from earnings. Number two, NAV trends. Watch the net asset value per share. Is it steadily eroding month after month? That's a big red flag. Is it stable or maybe even rising, especially while the stock trades at a discount? That's generally bullish. Number three, CLO market health. Keep an eye on default rates and credit quality trends within the overall leveraged loan market. If defaults start spiking across the board, that's going to directly impact OXLC's underlying assets and income. Trouble ahead. And number four, leverage ratio. Watch how much debt the fund is using. Is the leverage creeping up to excessive levels? That increases risk, especially if market conditions turn sour. You want to see prudent use of leverage.
NII, NAV, default rates, leverage.
Got it. And beyond just watching, are there any sort of smart ways to approach actually putting money into something this volatile, assuming someone decides it's right for them?
Yes, definitely some tactical considerations for playing it smart. First and foremost, position sizing. This cannot be stressed enough. Treat OXLC as a satellite position, maybe a small speculative income booster. Not the core of your portfolio. We're talking maybe 2%, 3%, perhaps up to 5% of your total investable assets for most people. Definitely not 20% or 30%. That would be asking for trouble given the volatility.
Keep it small. Makes sense. What else?
Consider layering in. Because the price can swing wildly, going all in at one price point is risky. Maybe think about dollar cost averaging, buying a fixed dollar amount at regular intervals. Or wait for significant dips, perhaps triggered by broader market fear, to potentially get better entry points.
So don't chase it higher, maybe wait for weakness.
That could be a prudent approach, yes. Third, reinvesting dividends. Some people love to reinvest those huge monthly payouts to try and compound returns faster. It can work wonders if the fund performs well and maintains the distribution.
Right.
But be warned, reinvesting also magnifies your risk. If the share price drops significantly after you've reinvested, your losses compound too. So, reinvest if you dare, but understand it increases your exposure.
High risk, high reward even on the reinvestment.
Okay.
Anything else?
Yeah, finally, consider pairing it. Because OXLC is so risky and volatile, it might make sense to deliberately pair it with much safer, more stable income sources elsewhere in your portfolio. Think things like short-duration U.S. Treasuries, maybe high-yield savings accounts or CDs currently, or possibly some high-quality investment-grade bond ETFs. Having that safety anchor can help balance out the wild ride that OXLC can be.
Hedge the risk, basically.
Exactly. Hedge the risk, diversify your income streams. So yeah, to wrap up the picture of OXLC, look, it's complex, it's definitely risky, it's highly volatile, and it is absolutely not a mainstream investment by any stretch. But, and this is the crux of it, for that specific type of investor who really digs in, understands the mechanics, understands the CLO market, and crucially, has the stomach to ride out the inevitable, sometimes severe bumps. It does offer something incredibly rare in today's market: income, serious, substantial income.
It really is a stark contrast, isn't it? You look around, benchmark treasuries are maybe paying 4%, 5%. Many classic dividend stocks, the so-called aristocrats, are yielding less than 3%. And then you have OXLC over here throwing off north of 20%. And importantly, it's doing that with actual tangible assets, those CLO tranches behind it. It's not just conjured out of thin air. That combination is not something you see every day. And let's be honest, it's probably not a situation that will last forever either. Market conditions change. So the big question for you listening, is OXLC worth it for you? Well, that really boils down to your personal tolerance for risk, how hungry you are for that high level of yield, and frankly, your willingness to venture pretty far off the beaten investment path. In a market that seems obsessed sometimes with the next AI bubble, or meme stocks, or maybe arguably overpriced blue chips, perhaps sometimes the rarest, most interesting opportunities are the ones like this, quietly churning out double-digit monthly income, while most of Wall Street seems to be looking the other way. Something to think about.